This week's going to be a very important week for the economy and markets, as Wednesday we have the crucial CPI inflation reading for July. This will confirm whether or not inflation's moderating or going down in a process known as disinflation. The Federal Reserve wants to see inflation go down in order to cut interest rates. It looks like right now that the base case is that the Federal Reserve will cut interest rates in the September meeting. The debate is whether or not if they'll cut interest rates by 25 basis points or 50 basis points. This CPI inflation reading on Wednesday will confirm that. I ultimately think that inflation will remain unchanged at 3% year over year, and then core CPI will remain unchanged at 3.3% as well. However, for the month over month, I expect that to accelerate from June, because June we saw a decline in inflation by 0.1%. I think this month we'll see an increase of 0.3% for the headline, and I think we'll see an increase of 0.2% for core CPI, which is CPI minus volatile food and energy. So that's my expectations. Obviously, we have the PPI inflation report on Tuesday. That'll be important for the markets and the economy as well, and could perhaps be a sign of what's to come in Wednesday's CPI inflation reading. We also have more economic data. We have jobless claims on Thursday, which has more significance considering that investors in the market seems to be even more concerned with the labor market right now than inflation. Because of the lower than expected and poor July jobs and unemployment report, the market sold off, and that was pretty much a catalyst into last Monday's sell-off, which led to the Japan carry trade unwinding and so on and so forth. So the market is spooked about a labor market deterioration. Last week's jobless claims number actually put a little bit of those fears to bay and at rest, and the market recovered. And despite last Monday's market drawdown, the market almost ended up being unchanged for the week, which is why it's important to be invested so you could capture the gains from a dramatic sell-off that we saw on Monday. If you weren't invested, you wouldn't miss out on those gains, and even better if you dollar cost average at some of the lows. But ultimately, this jobless claims number will also have significance to see if the better than expected jobless claims number last week could hold into this week as well. So a lot of people are paying attention to that. And then retail sales is coming out on Thursday. And a lot of people are seeing a lot of investors are seeing if the consumer remains strong, because consumer spending takes into account about 70% of GDP. So we want to see how strong the consumer is with retail sales. We also have Home Depot earnings this week. So there's going to be tons of economic and market data this week. Obviously, there's Fed speakers talking. Ultimately, as I said earlier, I think that the CPI inflation reading and the jobs claims number are the most important, and they'll confirm whether or not if the Federal Reserve will cut interest rates by 25 or 50 basis points in the September meeting. I think a 25 basis point cut by the Fed is almost guaranteed at this point. I don't think, as I said earlier, that the Federal Reserve should do an emergency rate cut, at least as of now. I think that would only show that the economy is deteriorating fast and that the Federal Reserve does not have in control. And I think if the Fed does an emergency rate cut, that would spook the market. So I don't think they should do that. But ultimately, these are the economic catalysts this week. I expect some volatility still due to the anxiety about the CPI inflation reading coming out this week, as well as the jobless claims number. But once we have some of that data, I expect some calm next week in the markets. It's just this week could be a little volatile until we have that clarity, in my opinion. And lastly, before I forget, the New York Federal Reserve had a survey of 3-year inflation expectations, and they came in at 2.3%. This is the lowest on record since the report began in 2013. This shows that people are expecting inflation to go down, and part of inflation is based on inflation expectations. So the fact that inflation is going down is a positive thing and could ultimately impact inflation down the road. We also have Trueflation, which is true inflation data based on the blockchain, which is inflation as of today. The blockchain has all kinds of real-time information, and it shows a 1.5% increase in inflation since last year. This compared to the Federal Reserve's 3% inflation metric from last year, at least from last month. First of all, the Federal Reserve uses lag data for their calculation, but the 1.5% Trueflation number I think is more accurate because it's used as current data as of today. And this is a good sign that inflation is slowing, and that does actually tee up the Federal Reserve to cut interest rates in September.